I'd love to get your take on the overall narratives we've been hearing going to year end. One is that we're seeing peak trade tension, maybe peak regulatory risk for technology. Fed's comfortable going into an election year, and that maybe 2020 is the year we can go above trend again. What do you think?
Well, I think the best forecast is a continuation of the moderate growth we've seen. That's around 2%. Above trend is possible in the year. Some of the uncertainty that weighed on the markets and certainly weighed on the economy earlier this year, 2019, some of that uncertainty is lifted. And so I think we have a rather benign outlook for the year. It's not gangbusters, but it's a good, solid performance, I think, ahead of us.
We've been talking all morning long about Fed balance sheet and this $100 billion a month pace. Does that continue after year end? How much is it solving versus creating unintended consequences? Do you have an overall thought on it?
Well, I think they are trying to deal with the repo market problem that occurred in September and making sure that they have enough liquidity in the system to have calm, or let's just say steady markets. And that's a little bit of a trial and error kind of thing. And they have been injecting more bank reserves into the system to try to make sure the repo market first got through year end, which we'll see in the next couple of days. And then secondly, continues without undue volatility. And that may take a little longer. It may go into the year, but I don't think it's an indefinite policy.
He did say earlier this month that it was unlikely to have macro implications, this repo volatility, that purchases were going to according to plan, and the money market pressure was subdued. Does the need for this expansion change after year end?
Well, this is not an expansion of the balance sheet that is trying necessarily to be stimulative or trying to juice the economy in some way. This is an expansion, and Jay Powell has been very clear that this is not a renewal of quantitative easing. So this is an expansion of the balance sheet, possibly on a temporary basis, that is really designed to deal with this very important funding market, the repo market. The general public is not well understood, but it is an extremely important market. Other markets are going to feed off of what's going on in the repo market, and that is the purpose of this particular expansion of the balance sheet.
Dennis, I get that that's the purpose, and I get that the Fed has been, pushing back on the idea that it's QE. But I mean, and this is according to Peter Bookvar, the average over the last 4 months, the Fed has been increasing its balance sheet by more than $101 billion per month. Just to put that in perspective, during QE3, the monthly average was $80 billion a month. So even if it's not actually QE, if you see the Fed pulling back on this at some point next year, what would be the effects on the broader market?
I would expect that they would pull back if they were satisfied that they had got the level of reserves in the broad system correct. And this, if you think about what led to this situation, they were in a normalization of the balance sheet mode. They were dropping basically reserve level to try to find the optimal level of reserves. And there was some miscalculation as to what the distribution of reserves would be among the banks and what would be the behavior of some of the key banks that were the large holders of reserves. So now they're trying to rectify that. Once they get it right, I would expect them to back off.
Dennis, just to look around the world a little bit as we head into 2020, we're seeing a stabilization in terms of global economic growth going into next year. We've got more clarity on Brexit, potentially more clarity or at least moving forward in a constructive way where U.S.-China trade talks are concerned on down the line. What does that mean in terms of central bank policy in other parts of the world? And also, I think specifically, negative interest rates and whether we start to see, I guess, a pullback on that.
Well, we've already seen Sweden pull back on negative interest rates. And it wouldn't totally surprise me if some of the other central banks try to move their sovereign rates into positive territory. I think that would be a very good sign. This negative interest rate environment has been extraordinary. I looked at a table that was put out by Bloomberg in October, and there were 14 countries with negative interest rates out to 10 years and 3 with negative sovereign rates out to 30 years. I mean, that is an unprecedented, extraordinary environment. And as the growth picture improves even a little bit, I would think that central banks could move away from that policy. The long-term consequences of negative interest rates are, of course, unknown, but I think there's a lot of very prudent talk about the impact on the banking system in some countries, and so I would certainly like to see that be a development in 2020.